breaking below or not yet what we saw yesterday at the lowest point. IT index, it's a flattish start. TCS, of course, will be in focus. Advanced decline is slightly positive, but not very much. Nothing to really write home about. And I think the Nifty heat map will come up on your screen, gives you a quick snapshot view of the action as far as the Nifty 50 stocks go. Many of them, of course, still opening up, and we'll have that up in a bit. There you go. I think got about 18 odd names which are in the green, and the rest are in the red right now. So 40 points lower, 23,646. Surabhi.
Okay, so let's get to it. Bajaj Auto is reacting very well to the CLSA note that Nimesh just flagged off. Gains about 2.5% on that stock. Make that 3% now, because remember, CLSA is looking at a price target of well above 9,000. I think 9,400 if I'm not mistaken. So that's the winner. Tata Motors with its JLR numbers also looking good this morning, 1% higher. Then you have some buying on Infosys, on Kotak Mahindra Bank. There's M&M, which is up about 0.5%. Basically, autos looking good. M&M, Bajaj Auto, Tata Motors, Eicher Motors, Hero Moto, even Maruti's got a tinge of green. Auto is the strongest part of the market right now, followed by the IT big boys. Infosys about 1% higher, and TCS is approaching numbers with cautious optimism, about 0.3% higher. What's not working for the market? Banks, banks, and banks. SBI is down about 1.5%. HDFC Bank is down 1%. ICICI is also slumping this morning, so not looking good for the big lenders. What else? There's ONGC, L&T. ONGC is finally cooling after 2 very smart days of gains. L&T is down about 0.5%. And there's ITC losing about 0.5% as well. So those are the early trends coming through. The big sort of trade this morning is on autos. Most of the stocks on the upside, and the Nifty is now down 56 points.
Well, the two stocks that I'm looking at is SRF as well as Navin Fluorine. There's been a big spike up in refrigerant gases because significant, there's a US distributor out there who's raised alarms over R32 and R125. That could be a bit of a supply constraint. And because of that, both these two stocks are now up between 9 to around 10%. We'll try to get you further details, but for the time being, that could add to their profitability. We'll have to find out how much exactly. That's clearly the reason why both these two stocks are now up close to around 10% or thereabouts. So big move is what we're seeing on both these two names. Let's pull up Hindalco. The stock had started off in the red. There is a likelihood that the stock could see some kind of bottom fishing. So, that one should come up for you on the screen. Hindalco, as we mentioned earlier today, the news is negative. The street will look ahead because of the correction that we have seen and the promise they're given that Q4 will, look as good as Q2. The other couple of stocks that we're looking at, Spandana Spurti has cooled off a little bit. We had Transformer and Rectifiers, one of the big outperformers in the last few years. Well, that one as well has come in for profit taking and came out with its set of numbers. The Nifty is now down close to around 60 points or thereabouts, but from the broader markets, plenty of stocks moving around. IGL bounces back up 2.5%. UPL as well up close to around 1.5%. And Aarti Industries is the other one that's up close to around 2.5%. Surabhi.
Okay, Nigel, well spotted on SRF and Navin Fluorine. Look at these stocks flying away. SRF is 10% higher. And Navin, I saw, also make that 10% of a move on, Navin Fluorine. Manappuram, the relief reaction continues, almost 5% up on that one.
Well, 60 points down on the Nifty, 23,630 is where we are at. And we are, down, and at least on the index level, we are down. By the way, broader market breadth is positive, not by much, by about 200 stocks more on the gaining side as compared to what is down. Maybe just a few other names here before we go any further. Nimesh spotted Bajaj with that sort of, I think it was CLSA, I think, 2% higher. So 87 on Bajaj Auto. Phoenix Limited, the mall operator, 3.5% there. There is Zydus Life, which is up about 3% or so, 1,012. Transrail, which is a recent listing, is up 5%. And, only mentioning these names because they've also got large volumes right now. Anand Rathi is up about 4% or so. Saregama is coming up with a 5.5% gain. So 578 on Saregama, looking good. Shakti Pumps now closing in on 1,400 rupees. It's up 30% in 2025. I mean, so it's just one of those names which has done very well. Car Trade is up about 3.5%. Car Trade, I think, was a mover yesterday as well. Tata Chemicals is up about 2%. Deepak Nitrite is up about 2.5%. Aarti Industries. So it's not just, I mean, SRF and Navin are there, but there are, maybe it's sparking a bit of an interest in some of the other names as well. Borosil Renewables is up 5%. It's one of the stocks we highlighted as part of our stock list early on in the morning. Spandana Spurti had a big pop yesterday, was up 35% in 2 days. It's taking a bit of a knock. It's down 5.5% on volumes, large volumes. And Credit Access ended up 12% yesterday. It's down 3%. So there are some small reversals. We just had that MFI discussion just a little while back. The other one on the downside is Kalyan Jewelers, which saw a big 8-9% knock. It's down, it's starting down, not big, but 1.5 lower. And you know, you had all these EMS companies, Dixon and Keynes, and you know, they were all down yesterday. Keynes is starting. I can spot only Keynes with volumes, which is down about 1.5%. Vari Energies and Premier Energy. These are the other two names which are in the renewable energy space, solar space, which are starting about 2.5% lower at this point in
Just
time.
one stock, Prashant, I wanted to highlight. SBI, the stock is trading at around 765.
Yeah.
The day's low is around 726. You know, so there appears there was there appears that, I don't know whether it's an erroneous trade or there is an intended trade out there. But in the first minute itself, there are a couple of trades that took place in that vicinity of around 726 rupees or so. Keep an eye on that.
That looks like a swoon. It looks like a what we call a fat finger or whatever. But we'll have to sort of confirm that. But yeah, the low is about 726.
By the way, the city gas distribution players are a little excited this morning.
Yeah.
IGL, MGL and Gujarat Gas, all of them are up. I thought maybe it's a IGL specific move because we know this Maharashtra gas IPO, the JV between BPCL, GAIL and IGL, maybe because of that. But no, the others are also excited in tandem. So city gas distribution plays doing quite okay this morning.
Yeah, Kotak Bank is another one which is up about 2% or so. You know, again, big underperformer last couple of years, and some sort of conversation that maybe it's one of the stocks to watch out for, at least tactically speaking, if not for the slightly longer term. Atul Suri is now joining us, CEO at Marathon Trends PMS. He's with us here in our studios. Atul, great to have you with us here. Good morning. Thanks very much.
Nice to be here. Thank you.
Yeah, it's starting. I mean, it's you know, we'll talk technicals, but the news flow you can't ignore either. There's
a lot. There's a lot that's going to keep you busy for the next 1 month.
I'm not talking about yields or rates.
Are you able to follow the posts and the memes?
I'm not talking about rates or yields or commodities. I'm talking about Greenland, Canada, Gulf of this. And
you have an exciting job for the next 1 month. See, for 20th, you've got the whole
next 1 month or 4 years?
4 years is a long. Then you talk about the Amrit Kaal. Let's talk about then 20 years.
How is it looking, Azul?
So I think that the next 1 month is definitely going to be very volatile because you've got three very big things, I think, that are panning out. One is this whole Trump trade. And already you can see that the world is shaping up for it. Bond yields have taken off. What's happened to the dollar is, I think, the biggest elephant in the room. That's affecting markets world over, whether we talk about it or not. Then you've got budgets, always unexpected, unknown. You don't know what's going to come out. And then you've got your corporate earnings, which actually is the biggest issue in our markets for the longer term sustainability. So within the next 1 month, you're going to have three such very big events, all three very unpredictable, a lot to talk about. But I guess, you're going to see volatility. But I feel beyond that, markets will settle up. So trying to, sort of make a call for one or two of these events is going to be difficult because, I mean, how will you pan out for this Trump trade? What is he going to do? What is he going to say? Which side of the bed he gets up from? I mean, these are things, where the best and best can't. So for us, I think it's more a question of reaction.
But directionally, Atul, is it looking,
So what I think, Prashant, that already the world is factoring this in. See, if you look at bond yields, right, the US 10-year, it's a very important instrument. It was around 3.6. Trump won the elections. It's moved 100 bips. It's at around 4.6 or so. An asset class which seemed to be sliding down because inflation was so-called capped, suddenly has taken off. What has happened to the dollar? Very important asset class, especially for risk on, risk off. All these FI flows. Why do FIs selling? Why are they this? It's nothing that they don't like India or it's a big deal. For them, the whole thing is we are just part of a big puzzle that there is playing out. And the way the dollar index took out from 107 heading to 109, that again tells you that the world is gearing up for inflation. See, because if you look at most of Trump's policies, whether he's talking about tariffs, whether he's talking about border immigration controls, whether he's talking about tax cuts, they tend to lean towards a higher inflation. And that is why markets are already factoring in it. Now, what comes out, how much does he posture, how much is just saber rattling, this only time will tell. I mean, as I said, we have no capacity to judge that. So I guess this is something that is going to play out. As I said, it's going to be very exciting. But how can you prepare for such events?
But again, directionally, just to, जैसे बोलते हैं, ऊपर का घर बंद है कि
No, I think that the market will surprise. In fact, what happens is that, see, right now we are at very important, very near crucial supports, which is your, I think, 23,300 or something, which was the last bottom. So that is one area which in the short term can be an issue right now. We're at 23,700 thereabouts. So that definitely is an area of concern. But, sometimes you feel, the breakdowns happen and suddenly the market has ways of pulling up. And on the upside, if you take out at 24,850, I think I remember was the last high, if that gets taken out, then you make a case for a new high. So I feel that in this period of lot of news, if the market just remains in this band, good day, when you start feeling bearish, the market takes off. And when you feel bullish, the market is going to, which is a typical range-bound movement. I personally would favor if something like that happens. Yeah, the bigger risk is if the breakdown happens. Because, remember, we are nearer to the lower band just by 2% or thereabouts. Then I feel that, it can lead to more.
When you said markets may surprise on the upside or the downside?
No, I feel that at the moment there's a lot of pessimism, Surbi. At the end of the day, people are worried, ye hoga, wo hoga. There's a lot more bad news. So that's good if the bad news is getting absorbed, it's getting factored in. And that is why even if you see the markets, they are not at lifetime highs. They are good 10-12% from there. We've spent a quarter or so of nothing. In fact, last 6 months, you'll realize that, if you look at it, there has been no substantial really gains. Yes, the market's made a new high. But portfolios, stocks, all the leaders are all off 20%, whether it's your defense, your PSUs, your private sector banks, barring IT, if you see. Most of the sectors and stocks are off 20%. So things have cooled off. Time has been spent. 6 months have been spent. Price has come off 15 to 20%, maybe 12-13% on the index also. I think that is important.
But Atul, before we start talking about what to do here, just complete that point on the two important indicators, both the US 10-year and the dollar, because now on the fundamental side, suddenly we're hearing, for the first time, narratives about maybe there is a global recession coming, maybe the US economy is going to... all of that
should be, you will keep hearing. Recession we've been hearing since 2 years.
Exactly.
One month it's inflation, second month it is recession. So that all is one big thing. But I said the two things that really matter to us as people in the markets, and these things are very, very solid indicators, is where the dollar is headed.
But what do you do you see anything?
Yeah, so a dollar at 109 is not a pretty space to be in. It's honestly not. I would rather have the dollar at 107 or below. That's the range it had set out for 2 years. We'd rather have a dollar there where we don't have to bother about it. Today, we have to be bothered about it because remember, when the dollar goes up, it leads to a risk-off trade. Like, we are getting shocked. Why FI is selling so much? As I said, it's not that they can't see the big India story. It's that they have multiple pressures. They are dealing in multiple asset classes, these whole global macro players, and what is the impact of the dollar, what currency they borrow in. And when US bond yields are going up, when they are getting at US interest rates at that price, then the need for them to be more adventurous and come to emerging markets where the risks are higher is less. So money is moving to the US, and that is very, very visible. Not a pretty place. It's been difficult. And I do think that the next 1 month is going to be challenging. A lot of news, but you just have to wait it out.
All right. Hi, Atul. Always good to see you. So next 1 month could be challenging. But for the year on the whole, sometimes when you get a lot of pessimism, it's actually good news.
Absolutely.
Because then, in fact, you expect the markets to be absorbing this and then gradually move up. For 2025, do you expect the markets to give a high single-digit return even from these levels? That's point number one. And point number two is, that's provided obviously the global markets don't collapse.
No, why single digit? Why?
I mean,
single digit is like, then an FD would be a good idea.
I'll tell you, Atul, from the kind of market talk that we've been hearing for the last couple of weeks or so, uncertainty on Trump, the dollar index, as you mentioned, 100, and if someone gets 10% this year, they'll be quite happy. I think, but so give us the optimistic. The last time we joined, I think we were talking about late 20,000, but tell us what is the level for this year?
No, I don't know about levels, but I do think that the first few months are going to be challenging.
Yes.
Even for India, our macros have slipped a bit. Your growth rates have slipped. Corporate earnings are not as they were about a year ago. So I do think that this is going to be, but I do feel again, it's a personal hunch that the government, whether in India, whether it's the US, these guys are very pro-growth. They are development. They are capitalist in their mindset. They want things to come up. They are not going to let this country economy just slip into a recession. They are going to put in the fight. So I do think that, right now, lack of government spending or less government spending is one of the biggest problems. I do think that they will come back. Whether it will happen in the budget or after that, we don't know. And that is why I feel that the recovery in the market will be more back-ended this year than front-ended. The next few months will have their challenges. As I said, it's very heavy on news. There is need for government action and policy, but I do feel it will come. And that's what, as you started the point, that when you are very pessimistic, that's when the seeds are sown. And as I said, that we've spent 6 months consolidating,
yes,
price-wise and time-wise also. Even price-wise, we're no way much higher than we were 6 months ago, right?
Yeah.
23,300 was the election day, I think, volatility high, and that is the support right now for the market. So we were where we were 6 months ago.
Atul, so let's talk about ways to look at
Sure.
So we had Sandeep Tandon of Quant earlier with us on Friday. He was saying maybe one way to do it is, first of all, the call that large caps will do better.
Sure.
Many have been beaten down quite a bit. And big laggards of 24 should do better in 25. A simple kind of. And it's, I think Nimesh later in the day is putting out a piece on edit, I think tomorrow. Saying, just looking at this, and it does his work by the underperformers the last year. Not all the time, but what's the hit rate? And he's looked at data going back
Dogs
the
of the
last 5
Dow.
years.
There's a lot of study
Exactly.
in the US that it's a trading system actually.
Do you think that is something to do here?
So I don't
our
know.
context?
I don't know about the buying the dogs of last year, but I do hold the idea that large caps will outperform. See, we do something called a ratio chart. I mean, unfortunately, I don't have it on screen today. But what happens is that when you do a small cap to large cap ratio, you will notice that there is a 3 to 4 year cycle. And if you look at it, large cap relative to small cap, since 2020, that's COVID, this has been the almost 4 years of relative underperformance. For 4 years, large caps have underperformed. And generally, we've seen that cyclically, these tend to be turning points. As I said, we don't know whether it's going to be this month or next month. That is very difficult to call.
Correct.
But yes, we are at extreme underperformance of large cap relative. These also become turning points. I'm not saying that please sell small and large caps. I think they will still have juice, but wherever the earnings will not support it, I think they will sell off. See, yesterday's market, if you look at it, yesterday the index was okay. It recovered. It was very pretty. But if you went and looked at the small and mid cap indexes and some of the stocks, there was a lot of blood out there. So what will happen is that optically your Nifty will look good, your market will look good, but in there the bleeding will happen. So I guess we are heading in that kind of situation. And in that sense of the term, it's also a better place to find protection in large caps.
So large caps.
Because what has not moved, where there's less euphoria, which is as it is beaten down, and if it's turning around. A case in point, a sector I love, Prashant, is IT. Right? I mean, a lot of people are talking about banks. There's consensus bullishness on banks, but I have not been bullish on banks, and I still am not bullish on banks. If I had to put my heart and hat in the largest to be overweight in any sector in large caps, it would be IT. Because if you look at some of the IT stocks, you'll find that a lot of them are pushing to new highs. And I think that is very, very exciting. IT is important because it's the second highest weightage after banks.
Yeah.
Because you need something to pull this market up. You need a heavy lifter. And I personally think large cap IT is a space I find very interesting.
So, Atul, to go back to your favorite line, right? The trend is your friend until it bends. Leave us with what you're seeing on the biggest trends of 2024. Now, and these stocks have already cooled off quite a bit from the highs, right? So,
Right.
capital goods, industrials, your ABB, Siemens, defense, railways. Where all have the trends now broken down in these high flyers? And where do you think there's still a scope that, maybe you buy the dip and the trend resumes?
Yeah, I mean, two sectors you spoke about which were darlings last year, defense and railways,
Yeah.
okay? Very similar in the PSU basket. You'll find that, yes, both got hammered. Post-election, there was a bit of loss of confidence in PSUs, but you'll find a lot of defense stocks have come back. They are nudging, they are pushing back, but railways haven't. So what you're seeing is very, very divergent trends that are playing out even among sectors and themes. Some themes that have continued to do well, things like hotels, continue to do well. In spite of the fall, they continue to make new highs. So I feel that there are going to be some themes and some sectors. But coming back to, the larger thing, what I was telling Prashant, that I also favor large caps.
Okay.
I also have a more bias towards IT. And there are going to be a lot of plays. Not that small and mid caps are going to do bad, but there are going to be plays. And I feel that these quarterly numbers are going to actually be very divergent for many companies. Index-wise, it may look, as I said, like yesterday, optically it looked all is well. But inside, there was a lot of damage. So I do feel that with this quarterly numbers, I think the market's going to get a little more bifurcated as to where the delivery of numbers happens. Well, they will all make new highs. Maybe the index doesn't. And wherever. So you will find a market where there will be number of 52 weeks high and 52 weeks low on the same day. And the index will be where it is, telling you that the market will be more divergent.
Absolutely, which is why I think we've been hearing this line that this is a year for the stock picker. It's probably not a broad brush stroke. You touch anything and it
As long as you pick the right stocks.
As long as you pick the right stocks. Absolutely. Thank you so much and wish you all the very best for 2025.
Thanks a lot. Thanks,
Look forward to more conversations, particularly as we get through this very exciting month of January. So catch you once the inauguration is done.
Thanks.
All right. With that, let's move to our next guest. And before we do that, just a quick update on the market as well. So it's a 80-point dip now on the Nifty. Nifty and Bank Nifty are in step. Both are down about 0.3%. And the mid-cap index is not too bad this morning. It's down 0.25%. So that's the situation as of now. Let's now move on and get the CLSA view on the Indian market in 2025. We have Vikash Kumar Jain joining in. Vikash, great to have you with us. Greetings of 2025. Wish you a very happy new year. So let's just take forward the conversation that we were having now. The thing is, as we've entered this year, there are too many moving parts, from the US economy to yields to dollar to a slowdown in earnings. Let me start with the last one first, because that's the India controllable, right? How optimistic are you about the second half earnings revival?
Well, I think there's always many moving parts when you start the year, and that's why what we do at the start of the year is we come out with a typical report, which is a very well-read report by our clients. It's called Themes for the Year, and this time we have 25 themes for 2025. And we discuss a lot of what you mentioned. Earnings, see, more than what I feel, I think it's also trying to understand where expectations are, where consensus is. Firstly, we at CLSA, we are about 2 to 4% below consensus as we start the year. And more importantly, when I look at just our numbers and certain key drivers that moves the earnings, that's moves the big stocks that determine the overall Nifty earnings, there is an assumption of normalization happening rather quickly in terms of growth in FY26. For example, things like credit growth. We are right now sub 11% credit growth. Broadly looking at the numbers that our team has baked in, somewhere closer to 12 to 13% is being assumed for FY26. Similarly, for commodity prices and profitability, we are assuming that things will improve. So there is a recovery that is baked into our numbers. And, our numbers are a little below consensus. So that maybe consensus baking in a little bit more of the recovery. Now, that is just normalization of growth. Now, the process of normalization, if it is a little slower, then after the weak GDP number that we saw in the second quarter, then there is obviously risk to earnings in FY26. If you remember the last quarter, we saw pretty big downgrades in earnings. So, further downgrades can be a bit problematic in terms of expectations of Nifty returns.
You're at 12 to 13% for FY25, Vikash, if I got that right, correct?
That is, we are at 12 to 13% of credit growth. The earnings number that consensus is baking in for FY26 is Nifty earnings growth is about 16%. We'd be slightly lower than that.
Okay. Vikash, hi, morning. Prashant here. So what I'm hearing is caution. So give us a directional view. Put it out there. What is your best sense? Lots of things in the mix, but you got to take a stand. So what's your sense?
No, absolutely. I think that's what we have done. So I'll tell you, India's expensive valuations is what is being talked about by everybody. What we have brought out this time, looking at the start of this year, is I am actually quite worried about the fact that Indian bonds, as compared to where the parity should be versus, say, US bonds, are looking more expensive. And Indian currency is looking more expensive. And both of that is what sets up, and particularly in the next 4 or 5 weeks where macro is going to be very important and big, that could be a little bit of a problem. Let me explain that. So Last year, we did not have any cuts from RBI, but Indian bond yields fell by 50 bips. In the US, Fed had several cuts, but US bond yields settled up by 80 bips. So Indian bond yields effectively outperformed by 130 bips during 2024. Currently, the differential between US and Indian bond yields, 10-year bond yields, is down to just close to 2%, a little over 2 percentage points or so. Now, to a naked eye, of course, that's one of the lowest we've seen in the last 18 years, but I'm less bothered about it because what I show in my report that this is something which tracks very closely with what is the forward market currency depreciation expectation. And that is more like 2.7%, 2.8% or so. So everything kept together, there is a chance, if US yields do not do anything, then Indian yields need to go up by almost 50 bips for us to get to that parity. Now, if we imagine that happening, and even if we assume that the bond and equity valuation differential remains at the bullish end, that is the max differential for earnings yield versus bond yield, and we go from 6.75 to 7.25% bond yield, then, we're struggling to get anything more than 2-3% return on the market, So I would say it's going to be tough to, and that too in the bull case, if there is a 50 bips move in bond yields. So we need bond yields to not go much higher, and also at the same point of time, expect that equity and bond differential stays very high, and we do not see earnings cut. I think that's a lot of things which are uncertain, and that's why I would say that not gunning for big returns, single-digit returns will be, if we scrape through with that, we'll be very happy with that. So there's going to be a period where things will go much cheaper, and then we can come back to hope for an up move. But net, don't think we're going to end with a very high number versus where we started this year.
Okay, all right. Hi, Vikas. Good morning. Good to see you in. You're sounding a little bit cautious, or a little bit would be an understatement. Worst case scenario, what do you think in terms of a downside for the Indian markets? We're 10% off the peak. How much more downside?
So let's not even take worst case. If you were to say that because of concerns of near-term growth, our valuations kind of normalize at 6.75% yield and assume that yields do not rise, which is, going to be difficult because that will mean US yields have to fall. Then even at that, just getting back to normalized differential versus bonds, we're looking at end of the year Nifty fair value at that scenario at 23,000. So even under that scenario, there could be downside for the market. So not really gunning, I think. See, we've had a great run. This could be that year of consolidation following, which started in October. That might very well continue. I would say if it's a very orderly kind of a correction and we scrape through with earnings catching up and valuations becoming more palatable, that's the best scenario one can imagine for the market.
Because those in it for the long term hold on and kind of hope to ride through 25 and look forward. I mean, that's the way for long term investors. But those more tactically oriented, are there anything things to do to protect the gains you've made, where you think we could see damage, take advantage of anything out there?
So I would say that most likely sometime during this year, maybe in the first half, we end up having a correction, and that could set us up for a great entry point for a lot of people, even the long-term guys, and even the ones who want to benefit on the long side once that period is done. See, first half is going to be very, very macro heavy. When Trump comes in, he's obviously not very predictable. What all does he do? What impact that has on the dollar? What impact that has on currency? Plus, we have our own,
Vikas, have you modeled that when you say correction in the first half? I mean, is there any way to say what are we looking at? We're at 23,600 or so right now.
Thankfully, I don't have to do that difficult a job of predicting Nifty every month. But so that's why we typically take a 12-month view. So that's something which I think a technician, maybe our colleague Lawrence, can do a much better job with. But
so what is he saying? Is he in agreement with you? We get a first half swoon?
I think he's obviously saying that the charts are not looking that great for India. I think that's something which he's been maintaining. I'm sure you guys talk to him more often. So he'll be the right one to speak about that.
So possible 7-10% kind of a sort of, I mean, that would typically qualify as a correction. I mean, if it's...
We already had a 10% correction, Shant. So we actually called for it around October, where our India Bull Bear Index, the sentiment gauge gave us a signal around end September that this is at an extreme bullish point, and we called for that.
Okay.
But you're saying from here you get a bit of a correction, right? H1.
See, I am saying that because of the macro setup. I am saying that,
I'm just saying, I'm just confirming. And so
That's
then
right.
from here, what do you see? You've already seen 10, another, 5-7%?
So,
And then that's the entry point?
so if you see, we are at about 19.5 kind of a PE right now. If you were to go down another 10% or so, then that would take you to very close to where the mean reversion should be to go to historical average valuations. And given the way India is positioned over the slightly longer term, which looks much better than most other economies, if you get the market near historical average valuations for a multi-year period, that's a great entry point.
Vikas, just to finally complete the picture, I just want to put up that chart that we had on with the underweights and overweights that CLSA has, just sector positioning. They're underweight on a lot of things, IT, discretionaries, industrials, and even healthcare. The overweights are only commodities and insurance. So Vikas, as you sign off, commodities, and obviously the market took note of your call specifically on Reliance Industries, which came out earlier this week. Just leave us with some broad setup in terms of hiding places, because you sort of outlined the underweight sectors. On commodities, is it just oil and gas, or in general, are you expecting metals to also move up? Just leave us with the explanation behind that construct.
In fact, you missed one sector. Our biggest overweight is actually staples. So we run an India-focused portfolio, and for the last 4 years, I've tended to completely avoid staples. And this time, at the start of the year, we've actually made staples our biggest overweight, cut our overweight in banks to just above neutral. And commodities, we have 4 names. We have metals as well, and oil and gas names as well. So staples, I believe that that's really the big sector call, which we have taken very anti-consensus. The kind of underspend that we have seen on government capex, both at the state level and the central level, I think that is also maybe hinting us on government's changing priorities. If that happens, the investment and the capex-linked stocks are already overexcited and at elevated valuations. But if priorities change to more welfare, affordable consumption side of things, then that's the sector which is, pretty beaten down because it's not done much for a lot of time. That's why we believe that the realities of coalition government and the hints that we have got from recent state elections, plus the good rainfall that we've seen and the good sowing that we've seen, maybe just bring back that affordable consumption to to kind of life. And within staples, we like the food-related companies more.
All right. Vikash, great chat. And, let's book you for right after the 20th of January. Because I think that'll be, we'll see. Reuters says over 20 executive orders on day one. And then we'll take it from there.
He's going to hit the road running, and that's why it's going to be very macro heavy.
Absolutely. Thank you very much. It's a pleasure, and speak to you soon again. Look forward to our next one. We'll take a quick commercial break here. We have the management of Signature Global to talk about the third quarter business update. So, real estate trends out of Gurgaon. We had one management from there in the morning, Ashiana. The second one, Rajat Katuria of Signature Global. Stay with us.
Welcome back. Well, let's focus on Signature Global. That's the next management on the show. The company has achieved the best ever 9-month pre-sales of around 8,670 crore rupees. To discuss this, demand trends, debt reduction, and also a word on the Gurgaon market, well, we're joined by Mr. Rajat Katuria, the CEO at Signature Global. Hi, Rajat. Good morning. Happy New Year to you, your family, entire team as well. 2025 has started off on a good note for you because of these numbers that we've got. Now, a couple of questions on the past quarter, the past 9 months, and what's the way ahead. Earlier, you were talking about pre-sales of close to around 10,000 crores. Well, that's well and truly on. Give us a revised estimate. You can't keep it hanging in the balance now. You'll have to deliver more than that. So how much better can you do? And on collections, which was lagging, it was at around 3,200 crores. You had a target of close to around 6,000 crores. Both are achievable?
So thanks for inviting us to your show and many, wishing you two a very great year ahead. So see, the core of our strategy has been to do mid-income housing. We want to be one of the leading or a very relevant player in the Gurgaon and the NCR market. In line of this strategy, we've been doing several new launches. We've done few good ones during this 9-month period as well, and are reaping the benefits of the same. If you look at our performance through this 9-month span, every quarter we are doing a steady 2.5 to 3,000 odd crores of sales, which is because we are able to create supply. So supply creations leading to kind of demand creation is the trend which we've been witnessing. In terms of pricing, Gurgaon did see a bit of a steep rise over the last couple of years, but the price at which we've sold during these 9 months on an average is about 12,500 rupees a square foot. So that's also kind of, stabilizing at that level. We feel that there could be more inflation-linked kind of price rise from this point in time. So it's a good, healthy situation for the business where, the price movement is not very sharp. We have a good land position in the company, and we intend to continue with the strategy of doing more and more supply. And, since these are at very select locations, we expect, demand to continue to be moving in the right direction. In terms of our guidance, as of now, we are maintaining those numbers while we seem very close to the pre-sales target and still a bit of work to do on the collection side. But we are, as of now, maintaining our guidance for the full year.
Okay, all right. So pre-sales at 10,000 crores, collections at 6,000 crores, holding on to that guidance. Got it. A quick word on this Gurgaon market. Yesterday we had Knight Frank. This morning we had Ashiana Housing as well. The indications are that demand is plateauing out. What's your take? Do you believe the same?
So, see, you need to really break it down a little more. So, in terms of the current inventory and on a relative basis, there's no science to it. But let's say if one was to say that mid-income housing or prices on an average basis range between 2 to 3 crores. If you go up a little on the premium side, there is inventory available at 5 to 6 crores levels. And then, you can go above $1 million mark for luxury or, uber luxury products. So our firm belief is that, if you play the mid-income game, which is this average ticket size between 2 to 3 crores, and even for this 9-month span, our average inventory has been at about, 2.5 odd crores per apartment. This is a non-cyclical business. As much supply you create, there is much and more demand in the market. You just need to be consistent with the supply and be a kind of a company on which people have comfort and they're ready to trust you with their money, hard-earned money. So we feel there is much more to achieve in the mid-income housing segment.
No, I completely take that. Rajat, hi, good morning. Prashant here. But you're saying you're not seeing what Ashiana told us. They specifically said for flats above the 4 crore price tag, there is a bit of a tapering off of demand that they're seeing. And it's not as if supply is overwhelmed, but they're seeing that. So you're saying that's not something you're seeing?
So Prashant, our strategy remains that, you do homes which are in the current, income context and, capital values context are, affordable for people, while 2.5 crores is a good enough ticket size, but, since the income levels in the country have risen and Gurgaon sees a lot of, families who have incomes between 50 lakhs to 1 crore, per annum as a household income, there is a very strong demand if you can come up with units which are in the price range of 2 to 3 crores. And, we continue our focus in that segment while we are experimenting on other segments as well. But if anyone can do, this, ticket size product, I don't think quantum is going to be a challenge.
Okay, all right. Mr. Katuri, I will leave it on that note. Thank you very much for joining in and giving us some perspective on how you see business playing out over the next couple of months. Well, moving on now, the electric vehicle race in the passenger car segment is definitely heating up. Mahindra & Mahindra, Maruti, Hyundai, JSW MG Motors, as well as Tata Motors, all of them are gunning to come out with new EV models. And the Auto Expo is going to be, center of attention now over the next week. We have first Parikshit joining in with more details on what the announcements have been so far and what's expected ahead. Parikshit.
Well, the electric passenger car market is all set to heat up. The competition is going to pick up, and how in 2025. You've got the Mahindra Group firing the first salvo. They had announced prices for the starting variants of their new electric vehicles, the BE6 and the XEV9 at rupees 18.9 lakhs and rupees 21.9 lakhs. Now the company has announced prices for the top variants, which start at 26.9 lakh rupees and 30.5 lakh rupees respectively. Bookings start on the 14th of February. Deliveries will begin from early March onwards. Now, the Mahindra Group has packed in a lot of features usually found in top luxury cars. These cars have ADAS Level 2 Plus, which can detect animals and barricades on the road. You've got Auto Park with a remote control option, 360-degree camera, driver and occupant monitoring system to check driver fatigue, 16-speaker Harman Kardon Dolby Atmos sound system, and augmented reality heads-up display. So the company's strategy is to give you a power-packed vehicle, which is a luxury offering stacked against the likes of Mercedes, which has the EQA SUV at a starting price tag of 67 lakh rupees, the Audi Q8 e-tron at rupees 1 crore 14 lakhs, BMW iX1 electric SUV starting at rupees 67 lakhs ex-showroom. Mahindra has also tried to bring parity with top-selling internal combustion SUVs in the market. The B6 and the XEV9e are priced between 19 lakhs and 30.5 lakhs. Then you have the XUV 700 from the Mahindra stable, and that is priced between 14 lakh rupees to 26 lakhs. For Creta, it is between 11 lakhs and 20.2 lakh rupees for the top variant. The Maruti Vitara costs between 14 lakhs for the entry-level model and rupees 20 lakhs for the top variant. And 15 lakhs is the price for the entry-level Safari SUV, and the top model of the Safari costs rupees 25 lakhs. So you are seeing that there is now some level of parity with the pricing between EVs and ICE vehicles. Now, with several electric cars being launched in 2025, there is bound to be a price war. Here's how others will stack up. Hyundai is launching the electric Creta at the Auto Expo, which is expected to be priced between 20 lakhs and 30 lakhs for different variants. The driving range for the e-Creta will be over 450 kilometers in a single charge. The e-Vitara is a ground-up electric vehicle being launched by Maruti. It is also expected to be priced aggressively between 20 lakhs and 30 lakhs across variants, and it will give you a range of over 500 kilometers in a single charge. Then you've got the Sierra and Harrier EV, which will be showcased at the Auto Expo. They will be launched in FY26, and they too will be priced very aggressively, and the range will be over 500 kilometers. So you are seeing very aggressively priced vehicles and a high range being offered by all OEMs. Already in 2024, we saw a lot of competition in the e-car market. Some of the top existing players like the Curve EV, which costs between 18 lakhs and 22 lakhs. You had the Mahindra positioning itself in this segment. Then you also have the ZS EV, which costs between 19 lakhs and 25 lakhs. The eXUV from Mahindra, which costs in the range of 15.5 lakhs and 17.69 lakhs. You've got the Windsor EV, which is doing very well, and it costs between 13.4 lakhs and 15.4 lakhs. Tata Motors continues to lead the electric passenger car market with sales of over 61,496 cars in 2024 compared to 60,100 EVs in 2023. Tata Motors has hit the sweet spot in terms of pricing as it offers cars like the Altroz EV, the Tiago EV, the Nexon EV, the Punch EV, the Curve EV, all in the range of 10 lakhs and 22 lakhs. But their market share has declined in 2024 to 62% from 73% in 2023. Now, this is because of competition from companies like JSW MG Motor, Mahindra eXUV, BYD, all increasing sales and their presence even though on a low base. 2025 could definitely be a turning point in electric car adoption in the country.
Okay, all right. Got that, Parikshit. Thank you very much. That's, very, very helpful and sets the stage, sets the agenda. So let's take the conversation forward now. Harma Sorabji, editor, Autocar India, as well as Jay Kale, who tracks the auto space at Elara Capital, are both joining in. Gentlemen, good morning to both of you and season's greetings. Wish you a, happy new year. Hopefully it's been a great start. Harma, so there you go. I mean, Parikshit laid out some of that excitement, and we've seen the headlines come through already, right? With M&M announcing the bigger battery packs and the pricing, I mean, cars for going up to about 30 lakhs, so on and so forth. But I want to hear from you because there's so much anticipation about Maruti finally unveiling its, EV plans as well. What are you expecting specifically at the Auto Expo? What should we watch out for in this big EV passenger vehicle fight?
Yeah, well, I think coming to Maruti, number one player in the market, still hasn't got an EV, while others have. So clearly, I think a lot of anticipation from the e-Vitara, which they're planning to launch. I think what's important to know is that this is a global product. I think 50% of production is going to be going to Europe and back to Japan as well. This is a product that's been developed alongside with Toyota. So really, close collaboration with them on this. So I think you can expect, a product that is quite sorted. It will deliver on the parameters it's expected to. What we hear is they have faced some delays in getting it to market. It was supposed to be, I think in March, it might be now pushed to a...
Oopsie.
Uh-oh. I think we've just lost Harmaz there, so we'll...
Yeah.
Harmaz, I think we'll... Yeah, we can hear you. Let's try it again. We lost you there in between. So if you could just repeat that point.
Sorry, is this better?
Yes.
Yeah. So I was just saying that the e-Vitara is a global product from Maruti Suzuki. It's a kind of collaboration with Toyota. You'll have the Toyota version coming. It's a lot of export potential for this product. In fact, 50% are for exports to Japan and Europe, and of course in India as well. So this is really a global product that's coming out from Maruti Suzuki. But I think really the one that has really swept everyone on and given a proper electric shock to the competition and the market is what Mahindra have done with their BE6 and XEV9e. Clearly, as Parikshit said, in terms of spec, in terms of design, in terms of performance, it's just hit it out of the park. So that's what one is expecting, from Mahindra, and a lot of other EVs coming. I mean, I foresee the EV market or the doubling in 2025 at the least. So I think you will see a penetration jump from what is around 2% to maybe even 4% going forward in 2025.
Okay, got it, Harmaz. Thanks a lot for that. Well, Jay, let's get you into the conversation then. What are you factoring in terms of number of units that Mahindra and Mahindra can sell from its EV basket? The pricing is very, very attractive. The market lead, I think last year, Tata sold roughly around 64,000 units. You can correct me on that number. So how much can Mahindra sell? On a monthly basis, can they do 5,000, 6,000 units, more than that?
Yeah, I mean, I think, good morning. And, like Harmaz said, I think they've really hit the ball out of the park, Mahindra, with their BEVs. I think very attractive pricing as well as, loaded with features. I think the design element is something to be talked about. It's definitely a head turner. And I think that, in BEVs, the problem is, of course, charging infrastructure, etc., has been an issue. But until and unless you give the customer that aspiration to own that vehicle, to kind of move away from the inconveniences of charging, I think EVs are not expected to pick up. And what Mahindra has done is given that customer that aspiration to own this kind of vehicle. So I think despite the inconveniences of charging and the issues that we see with the EVs, I think we are expecting a pretty good volumes from Mahindra BEVs going forward. I think they've recently announced the top-end variant pricing as well. The bookings are expected to open up from February. We hear of a pretty good response on ground for them. So definitely, in what we are factoring into our numbers is definitely more than the 5,000-6,000 that you mentioned per month basis on a sustainable basis in the next few months. They have a eventual capacity of around 10,000, which of course will be taken up further in FY27 as well. So yes, definitely, this is the year where you could see the EV penetration, which has been lagging quite a bit in the last few months. should kind of take off with incrementally so many launches coming in. I think the new model launches were pretty crucial for the EV segment to take off from here. And I think we are seeing that inflection point currently.
Okay, so perhaps higher EV penetration as the fight heats up. Hormaz, so if I were to ask you about the top 3 automakers that you'll watch out for that will start winning this domestic EV fight, which would those companies be?
I think definitely Mahindra, has got a lot of, let's say, interest. It's, I think, as Jai was saying, that people will kind of, forget about the slight inconveniences of the charging infra, which still remains a big issue. And fundamentally, it's home charging, not so much the public charging, because home charging is really where people want to charge their vehicles. That's where the convenience is. But I think, people are going to kind of, let's say, looking at the design of something like the BE6, people are just going like, wow, and they want to have it irrespective of what the powertrain is. Pricing is also very, very good. So I think, it's looking really good for Mahindra. I would say that they're on a very, very strong wicket with their 2 products. Again, it has to hit the market. They have to make sure that they are reliable. Software glitches, which is quite common, even in Mahindra vehicles, they need to sort that out. They've got a lot of tech in there. They've got a full new Ethernet-based, electronic architecture. So it's very powerful, very sophisticated, but at the same time, it needs to be stable and sorted out. So I think that's what they'll be working on. I think Maruti Suzuki, just by their sheer size and their sheer penetration of their network, they'll pick up some good numbers with the e-Vitara. Not sure what they're going to price it, but I don't think it will be super competitively, because I think what they are banking on is their global quality standards to kind of, let's say, appeal to customers over there. Same with the Hyundai Creta. Creta itself is the best-selling SUV in its category today. It's about second or third best-selling car in the market period. So when you get an electric version of that, you will automatically have, substantial numbers. You can't rule out Tata Motors, but I think Tata Motors will be under pressure for EV market share this year. They've dropped, as we've seen, to 62%. They've got the Harrier coming out, and they've got even the Sierra. But I think, they will face some stiff competition in 2025 for sure, which is turning out to be the year of the EV.
Absolutely. Got that, Hormaz. Thanks very much. Jay, very quickly, what are your top buys in autos right now, in four-wheelers?
Yes, in four-wheelers, it's of course, you have Mahindra and Maruti are the top buys in four-wheelers, and in two-wheelers, it's TVS and Bajaj.
Okay. All right, gentlemen. Got it. Thank you very much for stopping by for that quick chat on the battle of the electric SUVs, should we say, or not just SUVs, the battle of the electric cars in the Indian market. Let's take a very quick break. Come back on the other side. We'll have Manisha Gupta joining in, and we'll get you more on the commodities markets. Welcome back. So the equity market's actually quite okay. Mid-caps have recovered. Let's find out what's happening in the commodity universe. We have Manisha with us in the studios now. Manisha, so what's catching your attention?
Well, the commodity markets are also okay. Thank you for asking. But copper really seems to be doing quite well. If you look at the overnight markets, well, we've seen gained nearly 2% within that. In 2025 so far, as you can see, copper really seems to be outperforming the overall metal space with 7% of gains. And in 2024, we saw the prices gain up by 5.5%. So it has been good going for copper. The last year, it wasn't the best performer, but this year, it definitely is determined to be the better one. And we've seen that in way of prices as well. So from a 5-month lows that we saw in December 2024, we have seen a smart rebound come in for prices. And we're trading at a 3-week highs at this point in time. Actually, in the last quarter of 2024, the copper prices declined by 10%. And that really seems to be reversing all of that at this point in time. Well, the strength clearly comes in from the China stimulus expectations, and more projected, more inclined ones is what the street is anticipating right now. Apart from that, the rapid adoption of EVs, I mean, you were having that discussion right now, those numbers look good as well. And the renewable energy numbers also are starting to stand up as we start 2025, and the projections therein, that sentiment also seems to be supporting copper. The refined production numbers also are expected to be on the weaker side because of the lower TRC numbers that we've seen come in for this quarter. From $35 a ton in the last quarter of 2024, it's $25 for the first quarter of 2025. So that tells you that the refined production perhaps could be on the lower side. Markets also are looking at and trading at a premium. If you look at the China copper premium, that stands at $70 a ton right now. It was $43 2 months ago. So markets are looking at Chinese coming back to buy copper as well. The UBS report that came in yesterday has been quite interesting. They expect the copper demand growth for 2025 globally to gain up by 3.2%. I mean, that's your cue and the reason that you saw copper prices gain up quite strongly. When you look at 2025, we have more banks and brokerages now upping their forecast for copper. UBS, for one, in their yesterday's report, has come out with $11,000 a ton of an expectation. And you have 10,000 to 10,400 coming in from JP Morgan, Goldman Sachs and Citi. And then around 10,000 is what you have the other banks and brokerages also putting that out. So the likes of ANZ's talked about 10,000, Bank of America and ING are talking about, again, 10,000, 9,500 to 10,000. So we are looking at higher numbers here. Currently, the copper prices are trading at 8,800. So from those kind of levels, as you can see, it's a lot of bullishness that 2025 could show you for this metal.
Okay, all right. So it's all about copper. Manisha, thank you very much for all the highlights over there. We need to take a break. But on the other side, our special segment, Market Masters. Today, Lata is in conversation with Anish Tawakli of ICICI Prudential Mutual Fund to talk about the market's way forward once we get through the Donald Trump swearing-in ceremony later this month.
Well, the Nifty has officially, or rather arithmetically, entered correction terrain. It is now over 10%, 10.1% down from its all-time high hit in September of 26,277. The stark reasons are clearly global and are for all to see. Dollar index over 109. The US 10-year yield is pretty close to 4.7, 4.68 today. And Donald Trump hasn't even been sworn in yet. So how do we navigate the next few months and even all of 2025? I have with me Anish Tawakle, Fund Manager, Equities at ICICI Prudential Fund. His blue chip fund has returned 27% in the past year and 15.5% since inception, while his manufacturing fund has returned over 35% in the past year and 22% since inception. Anish, good morning and thank you very much indeed for dropping into our studio.
Morning, Lata. Pleasure being here.
Well, we have seen this Trump trade already getting played out. Do you think that we will see worse? 4.7 on the US 10-year and 109 on dollar. What should we be prepared for?
So the interesting thing is the trade is playing out differently in the US equity markets and in the bond markets, right? That's the stark contrast. The US equity markets have done very well, but bond yields have gone up. And I think the bond yields, bond markets are right to be worried because if you look at the US economy right now, unemployment is very low, which tells you that the economy is already operating at full capacity. So at this point in time, right, the right fiscal strategy would be to raise taxes, not cut taxes, right? So fiscal deficit is high, starting bond debt levels are high. And if you're going to cut taxes in a booming economy, the bond markets are right to be worried.
Yeah, you will get inflation.
Yeah, you will get inflation and will be priced in by the bond markets, or the Fed will have to step in and say we can't cut rates, we might even have to hike rates. And I think the Fed has already expressed concerns about the fiscal
the minutes said
that.
that.
Minutes said that, right? So I think how the equity markets react to the bond yields rising is something that we need to see. I would expect at some point the equity markets will take note of that. Okay. Having said that, it's not that much of a risk for the Indian economy, right? I'm distinguishing between the economy and the markets because there is a divergence that can persist for a while.
Oh yes, that's very important, of course. That Indian financial markets may have an issue with dollars going away, but the economy is in a different piece. But let me just finish the the US argument a bit and then come to the Indian earnings story as well. Do you therefore think that we can be in for further rallies in the dollar and increases in yields? Or do you think most is priced in? I mean, people are pretty scared about Jan 20th and thereafter. But you think that this trade can go on?
No, I would be of the view that the dollar has probably peaked, right? I don't think, I mean, if bond yields are rising because markets are worried about the sustainability of the fiscal deficit, that's not an environment where the dollar should appreciate, right? And that's another disconnect between the currency markets and the bond markets, right? See, if interest rates are going up because your economy is strong, it's normal for your currency to appreciate, but that's not what's happening here, right? The economy was already strong. The interest rates, the bond yields are not moving up because the economy is strong. Bond yields are moving up because the markets are worried about your ability to finance your deficits. That's not an environment where I would expect the dollar to appreciate further.
And the equity markets to continue with this kind of exuberance. Yeah, I mean, that is the big worry. So you're in the camp which believes that a lot of the bad news is, or a lot of the Trump trade is probably priced in. You know, we get both these views. Some saying that, you know, he can still drive things further. Whatever, 110 on the dollar. There was one person speaking of 112 as well. But many of them saying that, you know, it can't get worse than this. But, you know, to come back to India, do you think that the earnings story is under threat? Because we saw the second quarter see a lot of earnings revision. And the biggest blow, of course, was GDP coming in at 5.4. Now, do you think that earnings tension is behind us?
So let me distinguish between the current sort of soft patch in the economy and the little bit of the outlook, right? I don't think there's any fundamental problem with the economy. I do think the economy can regain momentum. There is no specific imbalance that threatens the outlook for the economy. And if it doesn't pick up on its own, there is room for monetary support clearly, right? So we are not taking the view that the economic slowdown should persist. We do think the economy should regain momentum. And earnings should therefore, which does not mean this quarter will be good, but we do expect that earnings momentum rebuilds, particularly if we get support, monetary support from the
So do you see earnings growth at around 15% coming back in FY26 itself? Or
so
I'm looking at Nifty EPS, of course, your own set of stocks could be different.
See, a little bit, I mean, it could be, I mean, it could be, it should be in that range. Yeah.
Okay, so now let's come to sectors. Where would you place your bets? Do you get, everybody who comes here are speaking that we prefer large cap over small cap. Everyone prefers banks because they have been the dog stocks, in the year gone by. Bank Nifty gave hardly, 4%, whereas at least Nifty returned 10%. So where would your preference be?
So clearly, we have been amongst the first to say that small cap is an area of concern, and that continues to be the case. The fact that there are so many promoters diluting, etc., tells us that reinforces our view that that segment is does not offer a good risk return trade-off. Now, if you look at sectorally, if you believe, as we do, that the economy will regain momentum, then we would be in the domestic cyclical space, right? I mean, which means stuff like cement, automobiles, capital goods, and also banks. Although there I would be careful amongst, I do think that...
Which banks?
I would go with the larger banks, and I would be careful of unsecured lending exposures in general, right? We are fairly cautious on that.
Okay.
So in the lending space, we are very cautious on the unsecured lending space.
Okay. So would you therefore prefer insurance then?
Insurance we have, and if you look at our business cycle fund, we are overweight insurance. That has been impacted a little bit by the regulatory uncertainties, but I think the outlook for the sector is, for demand is good.
Yeah. For the industry itself cannot be questioned. Yeah. Okay. Now, what about consumption? Because we did see a big dip in consumption in the second quarter, and the GDP numbers also showed, but the advanced GDP numbers are showing an improvement in consumption. Is it staples or is it consumer discretionaries? Gold companies, hotel companies, airline companies. Which side? Which part of the K, if you please?
So actually, my issue with FMCG companies, right, is not that the economy is weak. See, the FMCG companies are reporting 0 to 2% growth.
Yes.
Right?
Some of them, yeah.
Now, reality is, even if the GDP went up from 5.5 to 7.5, it's not as it's not that there's 0 to 2 is going to go to 7.
Yes.
Right? So I don't think the problem with the FMCG companies is the macroeconomy.
Okay.
The problem, in my view, with the FMCG companies is they are over-earning. I think their margins are too high, and therefore they have to come to
terms with the reality.
They have to come to terms with the reality. So I think there need to be earnings downgrades in the FMCG sector as these companies take some margin correction, invest more in the business.
Okay.
They're good companies.
Yes.
This is exactly what happened if you go back to the early 2000s. The same thing had happened. Margins were very high.
Yes.
Volume growth had collapsed. And it took some time before these companies finally accepted that, look, we will...
Corrected their business strategy.
So I don't ascribe the FMCG sector's challenges to the macroeconomic situation. I think it's more internal.
But what about discretionaries? You still would be very...
So discretionary should pick up if the economy regains momentum. Right?
So your top sectors would be construction, cement?
Cement, capital goods, and automobiles.
Okay. You're not very positive on IT?
So IT, I think the dollar strength is done. And look, I mean, what I've been wondering with the IT narrative is that the US economy is already strong, right? It's not as the US economy is weak.
Yes.
So I'm wondering...
So how much more can you get?
How many more can you get? And also, I mean, how much of the the Indian IT sector, right, is not just the Indian listed companies. The captives are also part of the Indian IT sector. GCCs are part of the Indian IT sector. So it's not as the Indian IT sector overall has been doing badly. The GCCs are growing.
Probably the listed are losing out.
I don't know what's happening, but that could be one of the possible explanations.
Okay. No, fair point.
So I don't want to bet on a big improvement in the Indian IT trajectory based on any...
Given the fact that you think that the US economy is already strong. Yeah. What about, more generally the return that you're expecting? Should we be prepared for lower returns in 2025? Or last year, in spite of the correction, we got 10% at least.
So the last few returns have been phenomenal, right? And typically when that happens, you have front-loaded some of the returns.
Some of this year's gains.
So you should be prepared for a little more moderate expectations going forward. But I'd never advise people to enter equities for a 1-year view, right? You have to take, in my view, at least a 3-year view. Okay. And if over a 3-year period, the economy does well, which is what we would expect, returns in the large cap space should be healthy. I would still worry about small and mid.
Do you think this is a time, would you advise, of course, you are the equity fund manager, but is it better to be in multi-asset at this point in time?
That is our view. I mean, we do think like asset allocation products are good at this point in time because you leave the decision to
the fund manager, someone who knows better, yes.
Who does that for a living. Yeah.
Okay, so I mean, considering that gold also gave very good returns last year. So where do you see the red flags? Which would be your avoid sectors?
So the avoid sectors, I would still say FMCG is a clear avoid for me. I'm also fairly concerned about metals, particularly ferrous, because I don't think China demand is coming back. And China demand is half of the global demand.
Yes.
So if that half is shrinking, no matter whatever mathematical gymnastics you do with the rest of the demand, you don't get growth.
You don't get that kind of demand.
Yeah. And so if overall demand for metals is under pressure or negative, I'm fairly cautious on metals. IT, as I said, right, it's not that exciting for me, particularly after the dollar move up. Okay. So those would be the 3 that I would avoid. And consumer unsecured lending is a clear avoid for us. And it has been for a while.
Oh, yes, of course, of course. What are the red flags you see? Do you think there can be some financial accident because of the kind of geopolitics we are handling in? We are kind of staring at. I mean, one day Greenland, one day Gulf of Mexico should be Gulf of America, things like that. Is there chances of an overview?
If you look at it from a purely mathematically, right? Any country where the bond yields, the long-term bond yields, start exceeding the nominal growth rate of the economy is a fairly risky situation. And if you look at the US bond yield, it's 4.7 now. You look at the Fed's forecast for nominal GDP growth rate, it's 4.6 this year, 4.1 next year, right? So and I mean, US population doesn't grow that fast. Productivity, they're already at peak performance.
No, so I take your point that
I think the US bond yields are clearly a source of
worry for the financial markets,
at least. And but having said that, in India, given that we have a solid foreign exchange reserve base, we can buffer ourselves from external volatility should that arise.
Okay, I'm being warned that I've exceeded my time. Very quickly, until now, when the FIIs moved out, you had the domestic money coming in. Are you confident that that stream will remain?
I never make any assumptions about flows. Okay, there is no good model for forecasting flows, and essentially, when you're betting on flows, you're betting on the greater fool theory. It's not a sensible investment strategy.
That's the best fund manager I can think of, someone who believes in earnings and not in flows.
I would not want to, I don't even spend any time trying to forecast flows. Zero.
This is absolutely the best advice you're giving us. Thank you very much, Anish Tawakli, for joining us. It's an excellent conversation we have had, wrapping up on Bazaar. On that note, Chartbusters coming up.